Welcome back. Rising demand for cold and flu meds has given Adcock Ingram a boost. During the full year period, the pharmaceutical manufacturer's over-the-counter turnover jumped 7.9%. This further boosted overall turnover, which came in 6% higher at 9.6 billion rand. HIPS, in the meantime, increased 10%. And joining me with greater insight on the group's performance is CEO Andy Hall. Thank you so much for your time, Andy. Now, the first thing that jumped out at me in the commentary was a good trading performance. Now, we seldom see that kind of wording in a results commentary nowadays. Was this due to internal efforts or a more supportive macro environment, or maybe both?
Yeah, I think it is a little bit of both. So we were fortunate in the second half of the year to have what we refer to as a good cold and flu season at Adcock Ingram. So in May and June, when there was a lot of cold and flu activity around cough and cold, we were quite happy about that. And then, of course, our prescription business, which is a very defensive part of our business, has had great momentum now for about 18 months or so, and that continued. So at the top line, we were very happy with the trading. But, you know, one could see that in the consumer part of the portfolio, consumers are still struggling. So there was a bit of a mixed bag at the top line.
Yeah, actually tell me about that, because I really was about to ask what the demand dynamics look like right now and if the current economic cycle is having a significant impact on that.
Yeah, certainly in the consumer portfolio it is. So what we're finding is that we really have to innovate well, move products into smaller pack sizes, make sure we're watching our competitors closely in terms of discounting and promotional activity. So there's no doubt that for us, while interest rates are still high and unemployment has been rising, that it's been a little bit more difficult in that part of the business. But on the more defensive side, prescription, OTC and hospital, there, we don't say this with any happiness, but there people still unfortunately have to get ill, and that portfolio still has robust demand.
All right. I hear you actually on, the fact that you have to provide more value in this current economic cycle where you have to have more promotional activity, and that comes with innovation. And I would imagine that also comes in under the umbrella of the effort of gaining market share. How is that effort of market share gains going? Is there any ground that you've covered there?
Yeah, we've had a decent year. So Adcock Ingram is the top pharmaceutical company in the private market in South Africa. We've gained some share this year, so we've moved up to a 9.9% market share. And the area where we've done particularly well is in that OTC business, where we service the cough, colds and flu and the allergy, etc. They're in Schedule 1 and 2 medicines, which are medicines that are dispensed on the advice of a pharmacist. We've grown our share to just short of 20%. And our volume share there, in fact, is now over 30%. So what it tells us that our sales and marketing efforts within pharmacy are certainly working. And when someone goes in and asks a pharmacist to recommend a product, there's a 1 in 3 chance that they're going to get an Adcock Ingram product. So our teams have done a really good job there in terms of marketing and selling.
Is any of that translating to your margin picture?
Yeah, the margin is an interesting one. So you would have seen some deleveraging from the revenue line to the gross margin line. And our difficulty there is that the majority of our products, whether they are finished goods or active ingredients, are imported in US dollar or euro terms. And our prices, of course, are controlled by the Department of Health, and we only get an adjustment once a year. So we had about an 11% additional cost on the Forex line, which caused the shrinkage in the gross margin. But to compensate for that, our operating teams really controlled operating expense as well. So although we deleveraged to the gross profit line, we managed to grow trading profit by 4%, and then further leverage down the income statement. We grew the headline earnings per share by 10%. So overall, with the assistance of some buybacks that we did at the center of the business, we still came out with a good result for the number that shareholders tend to focus on.
You talk about currency movements there. What impacts are you seeing there?
Yeah, so we hedge all of our purchases the minute we take them out, and about 60% of our purchases are in euros and about
Okay.
40% in dollars. So what we tend to have is whatever the spot rate is, we pay a small premium, obviously, to take out FECs. And then those FECs tend to take about 3 to 6 months to roll out across our business. So we have a kind of a lag effect where now where you would have seen some rand strengthening, we won't see the positive impact on our margin with that rand strengthening till about October or November this year. But generally, a strong rand for Adcock Ingram means better margins, and a weak rand means thinner margins.
Yeah, of course. You also, I mean, you mentioned that price realization, but would you say now, with everything taken into account, that that's kind of limited?
Look, I don't think so. So we still think if we get an inflationary increase from the Department of Health in 2025, that should help us to mitigate any margin squeeze in the regulated portfolio. And now with interest rates likely to come down, and with inflation having come down, the consumers, we think, having a little bit more discretionary spend, probably from the end of this year or early 2025, we think there is still the ability to put some price through on the premium brands, particularly brands like Panado, Citrus Soda, where they're really iconic brands that customers tend to go to when they need them.
Yeah, you've also had quite a good success in terms of your cost control. How have you managed that, and is the runway for that looking longer in the short to medium term?
We get this question from shareholders every time. How have you managed to do it, and what's going to happen next year?
Yeah, how much more fat
Um,
can you trim?
yeah, I do believe that, we can't keep squeezing blood out of a stone forever. So I
Sure.
would suggest that we're probably going to see inflationary type level cost increases in the business over the next year, particularly in salaries and wages. We do
Okay.
need to keep our people and make sure that we're retaining. So I would suspect that we see those sorts of increases in the year going forward. The other area I think we need to be careful is on marketing spend. Cutting marketing spend is never a clever thing in the long run.
Yeah.
And we've got to be really careful that on our big brands, particularly in the consumer business, that we're making the right investments above the line.
All right. Andy, as we wrap up the conversation, what does the upward momentum of performance from here on out hinge on, at least in the short to medium term?
Look, as I said, I think there's some scope for consumer recovery, probably in about 3 to 4 months' time. And then we'll continue to do multinational partnerships. We've got a couple of opportunities on the table at the moment with a couple of well-respected multinational companies. We've purchased a sunscreen brand in June, which has come on board in the business in July, which we are really positive about, where we can increase distribution. And we'll continue to look for mainly products in non-price regulated categories like baby care and personal care, because we are finding that in that sector of the market, once we get decent brands in, our team certainly know how to market and sell these products.
All right. Well, thank you so much for your time and giving us more detail on those numbers that came out of Adcock Ingram this morning, Andy. That was the CEO of Adcock Ingram, Andy Hall.